Hey everyone, Couch Investor back to another Lemonade video for today. So we have two things we need to discuss in this video. One, obviously the Q3 earnings report, and two, the acquisition of Metromile. To be honest, I did not see this coming at all, but let's have a look at what that acquisition entails and why it actually makes sense for Lemonade to acquire Metromile right now. So Lemonade will acquire Metromile. That deal will only close in Q2 2022. After it has been approved by Metromile shareholders. The transaction is an all-stock one that implies a fully diluted equity value of approximately $500 million or just over $200 million net of cash. By the way, I believe that when Metromile went through the SPAC route with Shamat, it was around $1 billion. So quite nice. And Metromile shareholders will receive Lemonade common shares at a ratio of 19:1. Now, Lemonade recently launched their car insurance. Right now, it's only available in Illinois, with Tennessee next. But what will Metromile bring to the table? Exactly this right here. Metromile's car-mounted precision sensors took over 400 million road trips in recent years, covering billions of miles and sending real-time streams to the Metromile cloud. These were cross-referenced with actual claims data, yielding precise prediction for losses per mile driven. Now, we all know how important data is, especially in insurance, but more importantly in car insurance. We talked about that with Tesla car insurance. Tesla obviously the leader in that new tech insurance for cars because one, they own the car, they own the data, they collected billions of miles driven already, and it just grows and grows exponentially. With Lemonade car insurance, obviously they had to start from scratch. So acquiring a company that has been doing this for years and years, that has collected 400 million road trips already and billions of data points, this is obviously going to help them a lot. Also, Metromile enjoys 49 state licenses, over $100 million of seasoned in-force premiums, over $250 million of cash on the balance sheet, and a team unmatched for their expertise and harnessing big data and AI for car insurance. So this will obviously facilitate Lemonade's car insurance in the short term. Obviously, they're buying a company with some cash on balance sheet, which is going to be good for R&D, sales and marketing, and just general administrative costs. And it will add $100 million in in-force premium. So all in all, I think this is a good move. I think this is something that they've been working on for a while. They have launched car insurance, but they probably launched car insurance now and been working on it very, very hard because they already talked about Metromile for a while. Also, Metromile as a company has lost a ton of value. Most of the people out there still think that Lemonade is overly overvalued. So the transaction being in all stock, I think is a good move. Now, before we jump into the earnings report, I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 free stock picks from their popular product, Stock Advisor. Now, Stock Advisor has beat the market by more than 4x. So all you have to do is go to fool.com/couchinvestor to get your free 10 stock picks now. All right, so I will add the Q2 numbers and guidance on the right here so you can compare, but basically they beat their own guidance. By the way, if my voice doesn't sound that great, I'm sick right now, so please bear with me. Now, in-force premium grew 84% year over year to $347 million. Premium per customer grew 26% year over year to 254. And then total customers grew 45% year over year to 1,363,754. They basically added around 150 something thousand customers, which is amazing. Gross earned premium grew 86% to $80 million. Now, gross loss ratio, I expected a bit better than this. It's at 77%, so not that great. But we're going to talk about that a bit later. All right, now remember last quarter they gave us the business mix breakdown, so I'll put that one here and now you can compare both. So in this quarter, the non-renters share of their overall book of business is ticking up to 47% from 44% last quarter. The pet line of business added 2% to its share, and life has increased from 1 to 2%, and homeowners stayed at 30%. Now, with regards to Europe, they're actually reallocating marketing dollars from the life business to Europe. That does not mean that they don't believe in the life business, That just means that right now they might see some better opportunities in growing that European market. Now, something very important, especially now that they launched car insurance as well, that's bundling. Obviously, this quarter they had no car insurance and no bundling regarding car insurance, but you can bundle homeowners and pet, renters and pet, life insurance as well. So bundling behavior is growing substantially across the book, with bundles now representing 8% of total IFP compared to 0% prior to the launch of pet insurance in Q3 2020. In Q3 2021, we recognized a record volume of cross sales at around $5 million and saw a more than 4x increase in the number of customers with policies in multiple lines of business relative to Q3 last year. While the average premium per customer across the book of business was $254, the premium per customers of bundled customers is 3 times higher. Alright, now the loss ratio. It's 77% now. Last year that was 72%. Now, obviously last year they did not have many products, so that loss ratio is automatically lower because we all know once you launch a new product in insurance, the first year or two, you always have higher gross loss ratio. Now they do already see some significant improvement in those new segments, with pet loss ratio improving 4 percentage points sequentially, while homeowners loss ratio improved 52 percentage points year over year. Now how will they keep improving this? They're prioritizing more profitable geographies, refiling rates across states to improve pricing and accuracy and adequacy, and are implementing rigorous CAT management strategy to better identify price and manage risk. Don't forget, this is still a very, very young company. Yes, they might have collected millions and billions of data points, but it's still a very, very young company. In the long term, they expect the loss ratio of all Lemonade products to be below 75%. Obviously, I would love to see it below 70%, but let's start with below 75. Now with third quarter revenue that came in at $35.7 million, increased by $17.9 million or 100% year over year, primarily due to the increase of gross earned premium during the quarter, increases in net investment income and commission income, and a modest reduction in the scope of their quota share program. They announced last quarter they went from 75% down to 70%. Obviously, in the future, I do expect that percentage to go lower and lower. Now, to not make this video too long, I'll just show you the cash and then the guidance for next quarter and full year. Now, for the cash, since it's not a profitable business, not even close, they still have enough cash to survive for a long, long time. They have a $1.1 billion in cash equivalents, and investments. That's almost double what they had 1 year ago. Alright, now for Q4 guidance, they expect a bit of the same, still growing year over year quite nicely and quarter over quarter as well. And for the full year, you can compare it again right here. In-force premiums still the same, but they did raise gross earned premiums and revenue as well. What they did reduce is the low end of their full year EBITDA guidance by $12 million. Right, so overall, the acquisition of Metromile, I think it's a good move. I think it's a move that will help them in the long term. Regarding Q3 quarter, I think it was a very good quarter. I don't see any red flags. Yes, that gross loss ratio, I expected it to be a bit lower, but hey, you can't win it all. Guidance still very good. I don't think they have any car insurance revenue calculated in that guidance. So there is that. Obviously, this video has been made before the earnings call. If there's something very, very important and significant that they mentioned during the call, I will let you know in a community post. But that will be it for this video. Let me know down in the comments below what you think about this quarter and what you think about the acquisition of Metromile. Let me know down in the comments below. And if you like this video, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. And as always, guys, take care, stay safe, and see you all in the next video. Bye bye.